Hey everyone, welcome back to Corporate Decoder. Today we're diving into a company report that's about as exciting as watching paint dry, but stick with me, we'll see if we can find some interesting numbers. I'm talking about VineBrook Homes Trust, a company that owns and operates single-family rental homes. VineBrook wants to be the biggest in workforce housing, and they've definitely grown. Since 2018, the number of homes they owned shot up by over 400%. That sounds like a lot, but let's see if all that growth is actually making money. Not so fast it seems, we need to look at some other numbers. For 2024, they reported a net loss of over $194 million. That's a big red flag, but it's better than the $20-80 million they lost the year before. So at least things are moving in the right direction. One good sign is that rental income went up for homes they've owned for a while. For these same home properties, rental income grew almost 7% compared to the previous year. This means they're either charging more in rent or keeping their houses filled with tenants, most likely a combination of both. Also, their net operating income for those same homes increased by almost 13%. Net operating income, or NOI, is just the money they make from rent after paying for basic things like property taxes and insurance. Speaking of rent, the average monthly rent per home was about $1,300. Also of note is occupancy being at 96%, but we need to consider if this is a house with 3 families inside, or if this is one family in a nice house at a good price that they take care of. On the other hand, they seem to be doing well in terms of resources, with cash on hand amounting to around $84 million. Plus they have cash coming in from operations, sales of homes, and they can borrow money if they need to. That's a good sign. To understand where their money is coming from, they got a loan known as the ABS2 loan, which is backed by their assets amounting to over $400 million. Furthermore, they got not 1 but 2 term loans to help pay the bills, so they are definitely leveraging other people's money to operate. It's important to note also that they sold over 1,000 houses during the year. This can mean 2 things. It can mean they are getting rid of properties that are bringing them down, or it can mean they can't make enough money to sustain a business and need the cash now, which is concerning. To see how these numbers stack up to company plans, their plan is to stay between 60-65% loan to value, with value being calculated as the value of their assets. As at the end of the year, they were at about 58%, so they have wiggle room but don't have a lot of breathing room to take on new loans. Here's something a little different. VineBrook has a side project called the Next Point Homes portfolio. It's made up of newer homes that don't need as much fixing up. The average rent is higher, around $1,700, and note that they might sell that portfolio soon, meaning it's not a main part of the business. Turns out the loss for the Next Point portfolio was around $71 million, so they are clearly losing money. The reason for this is their expenses are too high, and it's more expensive to operate this segment. They're now concerned about cybersecurity since they store a lot of sensitive resident information. They acknowledge that a breach could mess up their operations. They have some risk policies in place, but who knows if that's enough. Speaking of regulations and risks, VineBrook is a REIT, which means they get special tax breaks, but they have to follow strict rules. There are significant risks that can come up with failing to maintain their REIT status. One of the interesting rules is the fact that they have to pay out 90% of their taxable income, but this might mean that they have to sell off assets in a hurry or take unfavorable loans if they don't have enough cash, just to keep that status. Lastly, if you're an investor in VineBrook, you should know that there isn't really a public market for their stock, so you can't just sell it whenever you want. The only way to get rid of your shares is usually to have the company buy them back, and the price they pay is based on their own made-up calculation known as the MAV. The board also has a long of Levoli with its share repurchase plan. There is no guarantee they will buy back all of your shares either, or they can just decide to suspend it without notice. That does not sound like a fun time. Now, let's shift to my impressions. It sounds like VineBrook is trying to walk a fine line between growth and profitability. While they've increased the number of homes they own, they are also still losing money on their operations, especially when we consider the losses for Next Point. While the management stresses that they are paying attention to the bottom line, the strategy to make money is not quite showing up. For now, I'm going to say I'm still skeptical about the company's direction, and I wouldn't want to invest in it. Their reliance on debt to fund expansion makes them vulnerable if the housing market slows down or interest rates rise, and you have no assurance of investment returns. Also, the lack of liquidity for the common stock is a serious issue for regular investors. That's all for this deep dive. If you found this helpful, give us a thumbs up, leave a comment, and don't forget to subscribe for more corporate analysis.